Hello, folks. I am David Russell, VP of Market Intelligence here at TradeStation, and it's great to be with everyone. I do this webinar every other week, and just go through some of the things we can do at the TradeStation platform. I use some different materials in Jesus. So before we get started, I'm going to share some links with you guys. Most of you guys, if you have worked with me before, you've gotten these links, although I have one new one today. So this there is a second one here. And this one. Let me just share this one like this. Again, if you have any issues, please email me at drussell@TradeStation. Okay. All right. So all symbols and trading ideas discussed by the instructors are for demonstrational purposes only and are not recommendations. Strategy trading and active trading is not suitable for everyone. Futures trading, options trading, and active trading is not suitable for everyone. Past historical performance does not guarantee future results and may not be indicative of future performance. All educational content and custom easy language studies provided are examples for educational purposes only. Neither TradeStation Group or any of its affiliates suggest or recommend trading, indicator scan strategies, or any other investment or trading advice of any kind. You alone assume any trading risks associated with the analysis and trading examples provided. Exchange traded funds or ETFs are subject to management fees and other expenses. Before making investment decisions, investors should carefully read the information found in the prospectus or summaries of prospectus if available, including investment objective risk, charges and expenses. The prospectus is available at tradestation.com/insights ETF disclosures, which we gave a link to. Please see the standardized returns tab in the workspace. Performance data shown reflects past performance, is no guarantee of future performance. The information provided is not meant to predict or project the performance of a specific investment or investment strategy, and current performance may be lower or higher than the performance data shown. Accordingly, this information should not be relied upon in making an investment decision. Okay. So, got a few things here. This is a workspace we start with. This is my main masterclass workspace. And there's a bunch of interesting things kind of happening in this market right now. I gave you guys a new workspace, which I'm actually going to use on November 10th. In honor of the Marine Corps birthday, we're going to do a master class in Art of TradeStation about market breadth. I just had to mention the Marine Corps. But anyway, we have this workspace is very similar. I just gave it to you now. Excuse me. It's going to be the same one that I share on November 10th. The main difference is we added this ETF standardized returns. This is something if you want to see the 1, 5, and 10-year performance of the different ETFs that we reference, there's a radar screen that will provide those as of the previous calendar month. It updates in real time. So right now, this will be showing the performance as of the end of October. The rest of this workspace is the same. It basically has the same concepts of looking at, well, actually what I did was the only difference is I hid these, the advanced decline indexes to show only the advanced decline line. But aside from that, it's pretty much the same thing that I've shown you guys before. So the only difference is we talk about any ETFs, that information is available in these standardized returns. Okay, so start by looking at the S&P here, and I think it's interesting. We've shown this. This is one of our new workspaces that we've shared more recently. And what's interesting about this is there's really an interesting kind of range in play here between about 3,800 or 3,850 and about 3,910. So if we look on the S&P, see this has 4 different charts. These 2 are the E-minis, hourly of the E-mini, and 4-hour. Sorry, and this is a 4-hour of the E-mini. This is the cash index daily and cash index hourly. Okay, so let's take a look at some of these. The first I want to point out is on the daily. There's a level, and we talked about this level a lot if you look back on Market Insights, right around 39.10. And that was a high back here in July and then a low in July. So it was a resistance, support. Then we come back down in early September. We tried to bounce at it. We tried to hold it. And then when we failed to hold it, this was the last Fed meeting, by the way, September 21st. We had a high of 39.07. This week, we're making a high of 39.05. Yesterday we had an inside day, today a bearish outside day. So these patterns are potentially bearish. However, when you look at a major event like the Fed meeting tomorrow, this is not normal sort of trend behavior. So if we end up with, some kind of more dovish turn from the Fed, this will simply become part of a period of consolidation. And if we don't, and we move lower, then this will have validity as a reversal pattern. In some ways, it doesn't mean a whole lot of anything right here. I think the key things to realize is that we have a resistance area right around here. And this is very important. And I'm honestly been really surprised as I read different people that no one's really talked about the importance of this level. Now, another thing that has happened is we have this level at 3,800, which was our high in early October. And it was our high and then we bounced at it last week. And now we're trying to also hold right around earlier we were today. I think yesterday we tried to hold the high from the 25th, and now we're just kind of sitting and we're just in this very tight range. So I think it's important just to realize that we have a range here, and it's really only about 100 points on the S&P. So, from my perspective, this is something that we can see just filling and chopping in here until we have clarity on the Fed. So that's the first thing I want to look at. Next is on the hourly. Now, this is something that we look at a lot. The approach of this chart is that you want to look for two of the three signals to be giving you a signal. So, for example, the MACD is one signal. This histogram, which is a direction of the 50-hour moving average, rising or falling, it's my own custom indicator, MA speed. This is the second indicator. The third indicator is stochastics. So, for example, yesterday, stochastics was oversold, which is a potentially bullish signal, and the 50-hour MA was rising. MACD was falling. So you had two bullish and one bearish, which is a modestly bullish signal, and it did continue higher. This morning, we had stochastics overbought, and we had MACD kind of turning down. So that was maybe modestly bearish. And you also had this sort of level, this kind of false breakout above that previous level. So at this point, I think we have to just also see that this is now back to a point where stochastics are oversold. And we're also back to, an interesting sort of thing, this 100-hour moving average, which is, it's not as important as a 50-hour, in my opinion. And these are more important for direction. But, now we're at a point when we've retraced a lot of this. Now, you can also look at this. We go to, I'm going to do it on the other chart. Let's go to, this is the hourly of just a plain cash index. So let's do a little drawing. Let's do Fibonacci retracement lines. And let's just look. So right here, we are right now, based on this move, kind of holding the 61% retracement line. And this is interesting because in a lot of these different moves, what we've done is we have held at different points. And the one that was most interesting, let me just show you, was we have at various times held like half. I think it was right here. There's a very interesting, no, I'm wrong. There was one point, I think it was, no, it was, I remember, is this. This is one that was an interesting signal that I was looking at, is that we did the same thing here. We held this level, this like 35.80, which was, in many cases, it was a level that had kind of emerged right around here. It was this false breakdown at the end of September. Then we came down and held it. So this level here, right around kind of 35.85, we snapped off of it back here around the 17th, and we retraced basically that kind of 61%. And now, so it's now we have another time with this, we pull back and we hold a support. In this case, this, we rip higher and then we retrace like 61%. So I'm just trying to look at how some of these different patterns are working out. In some ways right now, none of this really matters a whole lot more than simply what people think about the Fed. And so I think, but it's always good to actually have those signals in place. The 4-hour futures is here. Now, this gave some interesting signals as well. And this is a chart that I've actually been very kind of impressed by. Its ability to use rate of change as a divergence. So if you look here, when we made this low, we had a higher low on the rate of change oscillator. And this is a bullish divergence signal. We saw similar things, for example, at the top where we had lower highs on the so we started to see these lower highs as we made a high. So these are all sort of interesting sort of patterns. What's also interesting here is we made a low with a higher low, and then it was followed by this rip higher. So this has been interesting signals overall. At this point, I mean, you can say it has bearish divergence, and this is what you would expect, though. You would expect to see a slowing of price into an event like this and at a resistance level. So from my perspective, none of this means very much right here, but it's interesting to watch. There is this downtrend that's been that I've drawn, and a lot of these breakouts have not worked. So I'm not going to put too much stock in it right now. Those are the main things I wanted to show you on this chart. That's the 4-chart futures that I've given you guys in one of the zip files. Okay, we also have here, by the way, this ES charting is an earlier version of the same thing. It's an earlier version of it. So this is one that I've kind of stopped using. All right. All right, so let's actually look at some of the things that are kind of happening here. If you guys have any questions, please let me know. Let's go to our masterclass, July 2021. I love this workspace. I've been using it now for a year and a half. And I've done a few things here with energy, but first I want to just kind of mention, when we look overall at something like long-term yields, I think it's important to realize that, we have broken a long-term, sort of trend. I think everyone knows that. And the thing is rates are going to stay high for a while. I think 4% on the 10-year is likely to be an area here of just overall stability. What I've noticed is that, this is an area that goes back, basically coming out of the financial crisis. This was the top. And, you're not going to, in my perspective, this is simply now something that we're going to sit at. The movement in rates could be done for now. It doesn't mean they're going to go down. We're likely to see the readjusting back to normalcy. And when you think of, in many ways, from a historical perspective, the entire last decade under 3% on the 10-year was just la la land. I mean, honestly, that's just kind of crazy. And it was because of the financial crisis. The Fed was, buying treasuries and rates were super low, and we were coming out of a financial crisis. And well, we did that. And that's been a decade now it's over. And I think it's important to realize that, that was a big deal, and it's simply over, but also we're now just going to maybe accommodate to this new normal. So all of that is just to say that something like 4%, if that becomes the new normal, the market can stabilize here and it will adjust to newer conditions. Before I do that, I want to just mention a couple of things that really say, why are the rates not going to really go down? Well, there's a few things to really think about. First is obviously the Fed's not going to probably cut them anytime soon. And really, why should they? I mean, it's one of those things where by keeping rates low, all the Fed does is it takes away its ammunition for future moves. If you're a policymaker and you want the ability to fix the economy in a recession, why would you take away all of your tools and your ability all your dry powder by keeping rates too low. So just from a simple kind of policy perspective, it makes sense for them to have rates higher so that they can cut them later. But then you look at it, today we had the JOLTS job openings number. I mean, massive beat to the upside. And we have actually, it's complicated. I have to go back and find the old article. But if you look at job growth divided by GDP, the economy goes through long-term cycles of there being growth that creates jobs more than others. And between about 1998 and about 2015, the economic growth did not create jobs. And the reason is because of globalization and because of cloud computing and a lot of other things like that that were happening in the economy. But since about 2015, we have seen recreation of jobs in the United States. And so at this point, that is a real positive. In some ways, it goes back to some things we saw back in like the 40s and 50s. So, I mean, we're talking long-term historical cycles. So the thing is, we're in one right now. Jobs are reshoring. We're seeing it all over the place. Baby boomers are leaving the workforce. So these things right now have achieved a sort of, structural tightness of the job market that will probably last for years into the future. So that right there is a major reason why rates are not going to go down. The second reason is the Fed needs to basically, unwind more of its balance sheet. They are going to be unwinding treasuries. They will be tapering. They just have to do it. And then the third thing is oil, which, at this point, when you look at it, I think that honestly, I wouldn't be surprised if after the election, they I don't know, it's about politics, but I think they're playing games with the oil market, to get down, to prevent, oil price from going too high. These are the government numbers. This is the SPR. I mean, it's pretty incredible. This is on the government website. I mean, it's incredible to look at this. We've basically taken this thing from, almost 700,000 barrels down to 400,000 barrels. And then the other thing here is that all these numbers, when we say inventories rose or whatever recently, I mean, let's just remember that the numbers that they release are commercial inventories. They're not actual inventories. They exclude the government, what the government's doing. If you look at the actual amount of oil that's lying around in the US, it continues to just go away. So, I mean, these things right now are interesting for energy. And I think this is, something that we just need to keep our eye on, because it's hard to see this ending. Or it's hard to see oil going lower in this environment. And if oil doesn't go lower, it's also hard to see, rates really moving significantly lower. So we're in this environment of higher rates, but that is not necessarily a bearish thing. We should remember that a lot of rallies have happened with rates moving higher, like 1985 through 1987, or what we saw between 2003 and 2007. Rates were moving higher in that. Well, they started moving higher in about 2004, but rates were moving higher. By the way, this is the small caps, IWM. Just a kind of interesting thing. We are seeing a real rotation to small caps, and this is kind of part of what I wanted to mention. The small caps here continue to kind of show some real relative strength. Last month was the Dow's best month since 1976, and the NASDAQ had a terrible month. Well, it was like a 2 to 3% up. The Dow is up like 14% or something. All right, so that's what I wanted to get into. We are now looking at a structurally, philosophically, different market, and that's not a surprise. From my perspective, we are probably going to see pretty much everything except technology do well, and I think that's the real kind of issue now with tech, is that everyone got so overly involved in it. So look at this sector analysis tab I have here. This is another workspace. This shows long-term comparisons of sectors against the S&P. Let's look here at XLK. I mean, this has been at this peak sort of level. And, I wouldn't overly state the importance of this thing. This shows the ratio of XLK against SPY. But this is a head and shoulders. And I would say here that when you look at the overall ratio here, it's interesting to just kind of realize that this is at a level that is just incredibly high. And then when we look at some of these other areas like energy, gaining, financials, I'm just going to type in XLF. Can the market move higher without the tech stocks? Well, that's the thing I'm going to say is that it can move slowly higher, but I'd say when you say the market, the S&P is going to be burdened by it. But then you have things like the small caps, and that seems to be what we're seeing now. So I'm going to show you some of these things. So anyway, this is what's happening. All these other areas. Let's look here at a 6-month performance, which is 125 days, and we can see here's the S&P as the benchmark. Let's look at everything that's below the S&P. It's basically, I mean, gold. We don't really care about gold, but we have the Chinese, which is tech stocks. We have semiconductors. We have FDN, which is basically the FANG stocks, the e-commerce stocks. Remember, these ETFs are not for trading. These are purely for benchmarking purposes. And then we have other things here like consumer discretionaries, which is basically Amazon. I mean, this is basically Amazon and Tesla. And then you also look at software, XLK. You know, aside from Apple, almost all the tech stocks are really doing poorly. So I think it's important to realize here that XLK overall is, you know, at a point where with the idea of rates staying higher and a lot of the other issues that are happening, like, for example, the exhaustion of cloud investment, the issues with semiconductors, which is just this huge realm of uncertainty now of slowing PC demand, slowing video games. And I honestly think that there's something going on with the video game industry right now. I think as people come out of coronavirus and we see, and I don't have real data on this, but you look at the performance of the industry and you look at the weakness in cloud computing, and you look at what NVIDIA has said. I mean, I can just put the pieces together, but there's a weakness in video games that has maybe reached a maximum growth for now as people say, you know what, I'll actually go and fly and see friends and family for the holidays instead of playing video games or whatever it is. With the video game area probably reached kind of a peak. And that's another big problem for semiconductors because that's a big use of some of these chips. So all these things together are just, you know, not great news for the entire technology sector. The higher interest rates, the exhaustion and the secular trends of cloud computing, video games, and those issues are out there. But then you look at just the opposite of the oil inventories and the job growth, and you see that there's other areas emerging, and it makes a ton of sense when you think about it. So that's something that popped up. So here's something I did recently. I found something very interesting. If we look at our market breadth, right, this shows a number of companies in the S&P hitting highs and lows. And what's interesting is we did hit this sort of high here last week. 30 companies in the S&P made new highs, and then yesterday 31 companies. Now here's a little analysis I did. Let's go over to here. I'm just going to go to masterclass. I'm going to go to, let's see, price grid. All right, let's just go down here and import. This is a set of energy stocks, but we're going to come back to that. Let me just go to data S&P 500. So now let's look for companies that have made new highs in the last month. Okay. So if we look for companies that when this reading is going to be under, it's pretty interesting here. If we look, we divide this. Let's just go to data, add blank row. All right. Let's just make that a label. All right. Now, if we look at this group, not a single one of these is a tech stock. If we go over here to fundamentals, it'll actually show if I go to fundamentals. there's a little analysis I was doing to write my article on Monday, which I thought was very interesting to actually find this. Not a single one of these companies that has recently made a 52-week high. If you look at the industry or you look at the sector, not a single technology company. That's fascinating. But you have a lot of healthcare, which is interesting. You have a lot of financials, a fair amount of energy, and a lot of consumer staples and consumer like the staple stocks are very interesting because, like I said, there has been a trend of people eating at home, and also these companies have a fair amount of pricing power. It's like the opposite of like we saw in with happening things like semiconductors now, cloud computing. Those guys are losing pricing power. So I just think it's interesting just to recognize that these are areas where you're seeing growth, or we're seeing the outperformance. But what really stands out to me here is healthcare, because when you look at the size of these industries, like financials and healthcare together, those guys, and then you look at some of the industrials that are doing well also, those stocks can offset the weakness in tech. Now, it is going to be a big weight on the S&P, but what we're seeing is those areas outperforming and making new highs and breaking out as tech struggles. When you look at the overall S&P, there's a reason to think that it's going to simply drift here for a while. And I think that that's really the case. But as that happens, we're also at a point now where we're going to see, or we have the beginnings of seeing a degree of of shifting to these new sectors we need to focus on. Sorry, I kept this open. I didn't organize my workspace as well today as I should have. But I thought it was interesting. I wanted to show you kind of how I did that, because it was really interesting to see all these companies, market breadth, seeing this big increase of companies making new highs, but not a single one was in the technology space. Now I want to show you something else I've done on TradingView. This compares the Dow against the NASDAQ. Look at this chart. This is basically, you can do this on TradingView, and you can also do it on TradeStation, but it's a little bit easier to do on TradingView. This is a weekly thing, and this shows that the NASDAQ divided by the Dow. This was the dot-com bubble, and this was November of last year. So I think it's interesting just to realize that this is kind of, we've seen this before. And coming out of dot-com, we saw this, and we're seeing something similar now. And it was an interesting playbook. It was housing, financials. Now, housing is different this time around because, the violence of the interest rate increases and stuff like that. It's going to be kind of a tricky one in terms of actually seeing housing take off. But you have the kind of unglamorous, untech stuff. And I think it's interesting to take a look at this. Now, one of the other things we can do quickly with TradingView that I'll show you is, if you do something similar, RUT, this is on TradingView, but you can do this on TradeStation. It just takes a minute longer. But if you compare the Russell against the NASDAQ, and there's a long-term weekly chart, it's pretty much the same thing. I've been looking at this and kind of looking at this. It's interesting. It actually makes a slightly higher low versus the Dow. So this points to small caps, financials, healthcare, industrials. And this is why I think we have to be careful of, just overly focusing on these tech stocks. They're not making highs. So that is right now, I think, the big takeaway that we're getting as we really let Radar Screen guide us. And that's everything I do. It's purely, what does Radar Screen tell me? Let's go back here to this sector workspace. XLV divided by SPY. Basically, it's gone nowhere for 7 years. This was after Obamacare. There was this huge rally in healthcare, and it's been basically flat ever since. And that's, but when you look at it, should healthcare go up. I mean, you think about it. Everyone knows that there's that secular growth in healthcare because of baby boomers, et cetera. And I think when you look at it, there is that argument, for healthcare that is there, and long term, is healthcare a growth industry? Most people would say it is. So it's interesting here to think about this and to see that it really, relative to the S&P, it's basically still flat for the last 7 years. So this is something that is really standing out to me. It makes sense that we would see this sort of strength in healthcare. Now, actually, you can look here. If I do IWM against S&P. Wait a second. How's this working? What happened? Here it is. All right, let me get this. All right, here we go. I might change this to monthly, maybe. You can see IWM has really struggled against S&P, and then we look at the Qs against S&P. You can see the same thing. The Qs hit this level. Now, what we could do is, if we wanted if we wanted to replicate this chart, what we would do is we would go in and we would change. This has two data. So we go to data. This has the main symbol, which is the one that with the green symbol linked to this radar screen. And then it has an embedded data of SPY. And then it's set up as a ratio spread. So whatever data 1 is shown as a ratio against data 2. And you can see that this is spread ratio, which is an indicator that needs to have 2 data inputs. You guys should understand. I've shown this before. I can explain more if you have questions. Thank you for reposting my link. I'll tell you, the one thing about Zoom that really does annoy me is that if I post something and people join that, they don't see it. I would have thought they would have fixed that by now. Okay, so this is just a similar thing I wanted to show you. All right. I want to take a long-term look at the S&P, and I'm just using TradingView because it's a little bit easier to do some of this big jumping around. I mean, TradingView doesn't have radar screens, so don't think I'm not loving TradeStation. It's just that it's easier to jump very quickly. S&P 500 long-term logarithmic chart. And what's interesting here is if you look at really where we've been, coronavirus, when you have something as unprecedented as that, it's not a surprise that we had this violation of the channel. And then when you look at the money printing that happened, it's not a surprise that we have this. In my view, the market was due for a good 2 to 3 year rally coming out of October 19, which is when we had the trade war with China. We were on our way there, and we probably, in my view, would have had something like this. I believe. Doesn't matter what I really believe, it's history. But the thing is we were setting up, in my view, for a breakout, like this breakout here, you see, in 16, after Trump came. That's when, this is the election, and then it was this steady uptrend, and then an acceleration into that crash. That's when people were too short the VIX. Anyway, steady move up. That's what I was pretty much expecting. And I think we were on our way there in early 2020, and then COVID came. And then we just went right back to where we were. The market was trending higher. And I think that if COVID hadn't have happened, we would have pretty much just done this. It would have been the same thing. It would have just gone like, and then it would have. So I think that that's just the trend. But the thing now is that when you really look at it from this longer term perspective, I mean, this trend and this channel is still, it still exists. So I think that's an interesting thing to kind of think about and to just kind of bear that in mind. Now I want to scan back to the mid 90s. Okay. And this is 1993 through 95. So this is when the Fed started hiking rates in the beginning of 94. And this is when they stopped hiking rates. So it's an interesting period of consolidation. And then when people had a sense the Fed was nearing the end, that's what you saw. So this pullback was only about 10%, unlike ours, which is around 20-something%. But it's still interesting just to kind of bear this in mind as a kind of model. It's interesting that as soon as that, this also kind of matched a year for the most part. We kind of from January to December, just a bad year, and then a breakout the next year. So I think it's interesting to bear this in mind. You also had at that point the Republicans win the midterms against a Democrat, and we might be setting up for something similar now. So I want to just point that out. A lot of people right now, just the negativity still remains incredibly high. But when you look at it, there are some historical things that are interesting as parallels. It's not to say that past repeats by any means, but it is interesting to see that we're at a point now where we are along the road of what the Fed has been doing of hiking rates. All right. Okay. I did want to show what's also interesting to me, like I said, this sort of cyclical economy, this sort of cyclical expansion we're seeing now. By the way, this is a fertilizer stock, CTVA. It's interesting. Haven't looked at this one much for a while. It's just for some reason it popped up on my chart. It's interesting, isn't it? So I wanted to just mention before I go to energy and stuff was in the industrials, I think are interesting to look at because when you look at FLR, this is a contract. These are like engineering stocks. A lot of these industrial stocks, General Electric, I mean, they've struggled. I mean, General Electric has struggled. But Caterpillar, that was the one that had very strong results. Honeywell, all these have kind of jumped. And then the other one I'll mention is Boeing in a very tight sort of, pattern here. So I think it's interesting to see what happens with industrials. They had a very strong October, and it's also the sort of thing you would expect to see of if we're in that sort of economy that is heavy on industrial, on capital investment, strong GDP, and strong jobs. The things like the industrials are going. That's a place where people could be looking. But what's really interesting to me is look at these stocks like FLR and PWR. These, maybe you don't know them all that well, but these are like engineering companies. And these are to me interesting because Fluor, no one really, I mean, Fluor is not that important, but if Fluor is doing something and someone is building something, Fluor has a piece of it. But more importantly, those contractors are going to use Caterpillar trucks. They're going to use wires. They're going to use capital equipment. They're going to use air conditioners and pipes and everything else that's industrial. If you hire Fluor when you're building like some giant factory or you're building like giant commercial stuff. I mean, that's what these guys do. They do major engineering projects. To see the strength in these companies is an interesting sign for the overall industrial sector. Another one that popped up that was just interesting to me, and this is I don't know very much about this company, but it had a very interesting move to the upside, and it's a small cap, but it had this interesting rally. Is HLIT. We talked about it recently. They had earnings today that were better than expected, and we have this interesting kind of pullback. They bought the rumor, they sold the news. But what's interesting about stocks like this that are trending higher is here we have our Keltner channel. Very often they will stabilize. And in 2 to 3 weeks, a name like this, let's see what happens, if it kind of bases out. This is one that I kind of am keeping on my list. I'd like to see something happening here in terms of, does it maybe touch the 50-day moving average? Does it touch the bottom of the Keltner channel? How exactly does this kind of shape out? But this company had a very interesting sort of breakout here, and it's pulling back. And to me, this is a name that we might want to kind of have on our list, HLIT. All right. I also did an idea on TradingView. Huh. All right. Interesting. You're asking about these. So first, over on TradingView, these are where I post ideas that you can look at. I'm going to share this link. It's interesting you ask about Archer Daniels, because we did an article here on Archer Daniels back on the 12th, indicating that it was fighting higher, and it has fought higher. So for me, This is very much the sort of stock that is on my radar here. This is the kind of unglamorous company that no one wants. This is one of these stocks that, like, you know, if you go to Silicon Valley and you talk about this, they'll like throw you out of the room. But these are the names that are working now. This has pricing power. At this point, you know, when you look at this going back to this high, you know, to me, at this point, it looks, you know, there's probably going to see a period of consolidation and chopping. The 92 level to me jumps out as a fairly, you know, important level here that we, you know, we might be looking for retests of. So from my perspective here, setting a price alert around 92 and a half, 93, seeing if we get that. It would also be near that rising 21-day moving average, which would probably be coming up there by that point in time. So I think that that is, you know, where I'm looking on Archer Daniels. Now, we had looked at that. Now, the one that we published today was ADP, the payroll company, automated data processing. This one to me is really interesting. If we look at this long period of consolidation, these higher lows as the market made, you know, lower lows, trend line breaking out. This to me is a name that is interesting. It's had some good earnings. And again, 1 million unfilled jobs, initial claims. I mean, everything, job market, very interesting. It's also an industrial. You know, people forget that a lot of industrial stocks are service companies. Another company that, I mean, these are not actively traded, but a name like Cintas is always one that is interesting to think about. They do uniforms for employees, like hotel employees and stuff like that, that's doing so well now. All right, so let me show you some of this stuff. All right, the other thing very quickly, I'm going to get to energy in a second, but I want to just, I'm going to end on energy, but I want to mention Johnson & Johnson bought ABMD, Abiomed. There's been a lot of activity in the pharma space. Eli Lilly today. All right. Interesting earnings beat, revenue beat, weak guidance, but here we are pulling back near the 21-day and this old high here. This is interesting. This stock has been very interesting. These pharmaceutical names, Gilead, REGN, VRTX. All these had better than expected earnings. BIIB. This stock has that potential for the Alzheimer's treatment happening. These are interesting. These are major pharmaceuticals, and this is what I'm talking about. You know, these stocks now are moving on real reasons. The other thing that's interesting is it doesn't seem like they face a huge amount of political risk now. It seems like people are talking about other stuff. Healthcare is no longer the punching bag, and big pharma is no longer the punching bag. Now we have big oil and we have Putin and we have a lot of fighting between the parties. Those are the people who the politicians now can go after. They go after each other, everything else. But big pharma is no longer, you know, the enemy of, you know, the people, so to speak, or whatever it was before, when the politicians would just slam it and talk about, you know. We also know there's going to be some kind of negotiated pricing with Medicare. And again, it's bad news, but as it actually happens, we can rally through bad news. So to me here, the healthcare industry, after literally 7 to 8 years of nothing, healthcare and financials together, those can replace tech. And that would be, in my view, what there's a potential narrative for 2023 is going to be money streaming out of Meta and Amazon and Google and Microsoft and going into healthcare, going into financials. That seems to be happening. It's interesting also to look at companies like Schwab, companies like look, HBAN. This was one that, I mean, the multiples on some of these are so low, and they're yielding, like, some of them are yielding over 4% on the dividend. They also set aside a lot of loan reserves. Let me show you something else, because honestly, to me, one of the strangest things I hear is that there's going to be a bunch of bad loans. This is the high yield. This shows junk bonds basically. And, you know, there's not a lot, you know, if you look at historically at when junk bonds look, see in this, all right, so if you look before most recessions, like in 2008, junk bond spreads were rising for like a year and a half. The other thing, non-farm payrolls were falling for like 6 to 8 months before the last recession. I'm not going to pull it up here. In the late 90s, junk bond spreads were rising for like 2 years. Now, you can argue other things about this because the Fed, you can say the Fed, by raising rates, is squeezing these yields, that the junk bond yields are not going up as fast as treasuries, and that might all be true. But this does not point toward a recession. So this idea that these companies, these banks are going to face these terrible losses and they have these loan loss provisions, it doesn't seem, it just doesn't fit historically with what we've seen. So it's more like, and I think what the market is seeing here, they're looking at these banks and they're saying these banks are probably going to repatriate those profits onto their income statements, those provisions. This kind of move in a stock like this shows that there's just no sellers. And a lot of these banks, look at something like Truist. I mean, these are the kind of stocks that have just, there's no one here who's trapped long. What's also interesting, if you look long-term at XLF, is that it basically held this level here. And if we look at really long-term on something like this, well, I don't have it easily. This is 2007, right? And this was, all right, so this is the long-term of the financials. This is your pre-financial crisis high. This is your pre-COVID high. And then where did we bounce? So again, how many sellers are in these names? These major reversals after CPI. Look at Bank of America's. I mean, this is this massive candle. And then it's just, so I think there's something we have to realize. This price action is kind of trying to tell us a picture of this sector is not widely owned. And when you look at this environment, that is to me something significant. So again, that's why I'm saying financials and the healthcare stocks, you put those two together right now, those are bona fide real industries that can, replace tech in terms of leadership. All right. So now let's look at energy, because energy has so many positives, like I've mentioned. So what I did was I have shared in one of the zip files I gave you guys. And again, it's hard for me to keep all these zip files necessarily straight. If you're missing something, email me at drussell@tradestation.com and I'll make sure you have it. I'm not gonna be able to go over the day trading one today. I'm sorry. I don't even have that loaded up right now, and I couldn't get it to work because I had too many other studies open. But anyway, let me just show you this thing with energy. So if you go into this into this spreadsheet I gave you, and you look for XLE and XOP, and you basically import all these stocks, that's what I've done here. All right, so that's what I had here in my price grid that I wanted to show you. So I'm going to go back here, and I'm going to basically erase everything else. And I'm just looking here for some of these names are anyway. All right, so I was looking for names here that have just kind of pulled back in the last week, and these were popping up on my list. In particular, Pioneer. This is very interesting to see it kind of holding right above this 21-day exponential. This kind of pricer around here. I mean, to me, this is just kind of popping up as, a potential signal here. And then the other one was CVI, which is a refinery stock. This was a name that this morning, it could have really provided a nice signal. I saw it early today and I was thinking, man, I'm going to tell some of my guys in masterclass. But look at this, it went down to that 21. And if we go to our MA tools, we can see right here, EMA test CVI. So this popped up early in the day, and I'll just show you that's how this sort of thing works. So what I've just kind of been doing is I go to my key ETFs, my first tab, and I see from that, pretty simply, yep, energy is leading. We see that 21 day, it's a 1 month change. It's pretty obvious energy is strong. Let's jump over here now to our price grid and let's just dump in our energy. Well, let's, after we know energy is strong, we go to our energy holdings from this sheet and we dump them into our price grid. And then we're going to just start looking for who's pulled back in the last week. Simple. And then we go to MA tools and we say who's actually pulling back and maybe holding something. And we see CVI. So this technique could have gotten an interesting opportunity early simply by kind of tracking those. So that's one thing I wanted to mention. Another thing is coal. I mean, it's a 4-letter word, but BTU, ARCH, Arch, AMR, maybe CNX. I can't remember if this is even forget about that one. I don't know if this company is even what their deal is anymore. But the ones that have been active are Arch, AMR, and BTU is the big one. They report earnings, I think tonight or tomorrow. But long term, it seems likely that the Europeans they're going to use coal again. I mean, the pricing of coal, everything about it is strong. This looks like a pretty interesting chart. Look at this high basing pattern along the 200-day moving average. For me, it's all about the thematic. What is the theme that's happening here? So those are some of the quick things I did. Now, the last thing I want to show you guys very quickly, let's go to scanner. Let's go to, let's just call it Find Energy. Now, the reason I do this is because, you never really, let's go to all stocks. We're looking for stocks. This is by default. And we go to $1 billion market cap, 500,000 average volume a day. I bring that in as my default. So it has to be $1 billion market cap and 500,000 shares a day. It excludes a bunch of random stuff. Let's just go here to indicator. Let's go to sector. And then let's just say equals. And now we have to use quotes. Energy. Run. Now this is important because you've got stocks like BP that you forget about. You've got some other, this Petrobras, which I mean, the Brazilian thing is interesting to me. I'm trying to kind of get my head around Latin America now because what's really interesting to me, and I'm not really much prepared to talk about now, but the Mexican peso is really performing. And I've seen a lot of interesting debate recently about, is the Mexican peso going to crash or is it going to rally? And there's been a debate between some different people on that. Someone was saying it was Moody's was bearish. And then a few days later, one of the big banks came out and was bullish on the Mexican peso. And it's interesting because if you think about it, jobs come back from China. Where do they go? They don't just go to America. They go to Mexico. And the Mexican economy is looking increasingly interesting to me from that perspective. Anyway, this has now generated a list of 100 energy stocks. So I can copy this. The one problem with Mexico is their energy sector is pretty bad. They haven't gotten their head out of the 1930s. Anyway, we go to price grid. We can just erase all of this. This is another way to do something similar and paste these in. What was interesting to me recently, I'm going to do the same thing here. Let's go to MA tools. Let's paste them in. Even go to fundamentals. We can paste them in. We can start looking at stuff like dividend yields and stuff like that. Petrobras. I wonder if that dividend yield is correct. EC, that is a Colombian company, but there we go. PXD, interesting. Dividend yield of 10%. You're going to find some of these pipeline companies as well, like ONEOK. Look at some of these stocks if you look at the monthlies on some of these, the long-term sort of monthly timeframes on these, it's really gone nowhere for a long time. And it's interesting. These are pipeline stocks that benefit. It's just as an overall sort of, part of energy. And they, a lot of them have some high dividend yields. But anyway, this is another way to look at this. Now, let's look here just at price grid. And we can just look in this sector and we can quickly see, tech is not really, I guess they're now more of a copper name. They used to be more coal oriented, but we can look down this list and we're going to find some unusual sort of, companies we haven't heard of. Some of these are oil field servicers. And what's interesting to me is two of the best performers last month were servicers. Schlumberger and Halliburton had huge moves, but then there's also companies like Nine. which is basically like a mini version of Halliburton, NOV, RIG, SLCA. You know, a lot of these had big moves early in the year, and now they're also at a point where they haven't gone anywhere for a while. Isn't this interesting? Look at that. Anyway, this is how I, think people might want to consider mining for some ideas based on the thematic, seeing the strength in energy, and then finding them using the ETF grid, using Scanner, like I just showed you, and basically, looking for opportunities. The good thing about something like energy is it tends to be very thematic. You get other kind of areas like industrials, which are not very thematic, and tech, which is not always, you get in tech, they have bad news or something, and one does well and one does bad. But with energy, it's for the most part, a rising tide lifts most ships. So, it's interesting now to be kind of looking at this and just bearing in mind, like I said, this scenario right now of oil inventories just depleting at the same time we have job growth, at the same time we have, all this positive, heavy economic activity, that is something that's going to be difficult to see significant downside in energy. All right, so those are the main things I was covering. Remember, I am going to be doing November 10th. I'm going to be going through breadth using the workspace that I shared. If time permits, can you talk about UNG and its holdings? UNG is, to me, very difficult, and I don't really have an understanding of it. It's a widow maker from what I can tell. There's a lot of strange things about natural gas futures. So I cannot talk about UNG, I'm afraid. All right. Archer Daniels, I did share on that. Good. All right, that's everything, guys. Great to talk to everyone. And we'll be back. Let me just tell you the next time I'm going to do in masterclass. It will be on the 15th. So hopefully I'll see you on the 10th and again on the 15th. Take care, folks.